Hi everyone, and welcome to today's webinar, Know Your Numbers. Can I just check that you can all hear me okay? If you can use the chat box on screen, and if someone could just let me know that you can hear me okay. Perfect, thanks guys. My name is Ikra Aslam and I am one of the client managers here at Rosen Associates, and I will be your moderator today. For those of you who are unfamiliar with the webinar environment, these are the Zoom settings. You can select audio settings to select and test your speakers. You can submit any questions that you have throughout the webinar using the Q&A button, and we'll answer any questions that you've got at the end of the webinar. You've also got the Leave Meeting button there. If you do need to leave the meeting at any time, you can do so, and you will have a little questionnaire pop up at the end of the webinar, so if you could please fill that in, as your feedback would be very helpful for us. Now I'd like to introduce today's presenter, Ian McLeish, who is the Director of Rosen Associates, and he will be talking through the webinar today. Welcome, Ian.
Thanks, Ikra, and thanks everyone for taking the time to come along and watch or listen to this webinar. Before I start, I'd like to set the scene a little and give a little background on what we're all about at Rosen Associates before we take a bit of a dive into the financial reports and what they mean. So at Rosen Associates, we know that the owners of small businesses want their businesses to survive and thrive. At the moment, some is more survive than thrive, but ultimately it will be thrive. So in order to do that, what they need are financial controls on their business and some business planning. And the problem at the moment is it's difficult to know what needs to be done and what the financial implications of their actions are going to be. So you can end up feeling quite out of control and confused. This is something I see quite a lot working with clients. So at Rosen Associates, we believe that if you understand the numbers more fully and what their financial reports are telling the business owners, they'll be in a much better position to influence the business going forward. So essentially, we believe that owners of small businesses have worked really hard, almost exclusively, really hard, and don't deserve to get less than they can from their businesses. That's one of the reasons we put together a whole range of services, including this webinar, to help our clients grow and thrive going forward. Now, I always like to share a thought for this session. And today's one is your budget, i.e. your planning, your forecasting, whatever, is not just a collection of numbers, but an expression of our values and aspirations. So what that means to me is that the numbers aren't just abstract amounts. They represent the results of the actions that we take on a day-to-day basis. And our actions are the result of our values, our beliefs, and our goals. So by knowing our values, beliefs, and goals and working with them, we can influence the numbers. That's the core of this, the idea of this webinar. So hopefully you've all updated your budgets and forecasts that you might have done back in December or January for the year, and you've changed them because of what's happened, the COVID-19 situation, obviously. Now, the numbers that you've got express your aspirations for the business over the next 12 months. Now it's time to make sure you can understand, monitor, and measure what you've set in those budgets and forecasts. So this webinar is essentially about demystifying the most common reports that you'll be seeing on a weekly, monthly, quarterly, and annual basis, so that you're in control of your business performance. In other words, your business should be there for you, not the other way around. You can influence and change what happens in your business by understanding, having the knowledge and the skills to make changes that will have a known effect on the numbers. That's the basic premise of this webinar. So this is what we're going to cover, hopefully around about 60 minutes, maybe less, maybe a little bit more, depending on how many questions there are at the end. So there's the importance of knowing your numbers. Why is it important to know your numbers? I've already touched on that a bit. We'll have a look at some of the different reports that you should be producing again, depending on your business, it could be daily, monthly, weekly, quarterly, certainly annually. We'll talk a little bit about the difference between profit and cash. This is one of the biggest puzzles I see with clients quite often is that, well, I've made a lot of money, my profit, especially if it's a sole trader where their drawings aren't part of the profit loss account. They go, well, he's telling me I made £45,000. I've only got sixpence in the bank. How's that? So understanding the difference between profits and cash is essential. We'll look at the drivers of business value. In other words, what things, if you measure them and influence them, can you do to improve your business value, the value of your business? We'll then go on to have a look at how to put all this into practice. What do you need to do in order to make this actually work in practice in your business? Then we'll have a quick look at some potential next steps that you could take and make sure that you actually truly understand your numbers. So before going further, I really want to emphasize, you really need to make some notes. There's no point in coming along to this and basically listening and going, yeah, that's very nice, but then not remembering any of it. So please do take lots of notes. Also, accountants often get told, I hear it now and again, that we use a language that's difficult to understand. If you like, it's jargon, So what I'm going to do is I'm going to try my hardest to avoid doing that. I'm going to try and make this simple. There are a few terms which you'll need to understand in order to understand your accounts and your reports. But I'll try to explain these clearly as we go. And if you've got any questions, please put them in the box and we'll deal them at the end. So, why do you need to know your numbers? I believe that most things in life and business, if you know why you're doing it or why it's necessary, it's much more likely that you're going to do it. A lot of businesses I work with don't understand why it's important to, at least when they come to us at first, they don't really understand why it's so important. So one of the reasons is it allows you to interpret your reports and know if you're on track to achieve your goals that you maybe set out in a business plan or your business recovery plan. So before we do look more closely at that, let me ask some questions. What is it about your business that keeps you awake at night? Now, we all have that. Maybe not every night, but there's always something about your business that keeps you awake at night. That's a sign of something that you either don't know or you're worried about. Could it be lack of cash? So you worry about how you're going to pay your team or your suppliers, or even worse, HMRC. Is it the never-ending amount of work that you need to get through? Sometimes it just seems to come in quicker than you're busy all day in, day out, long days, and never seem to get an end to it. Is it confusion that keeps you awake? I mean, how come I made a profit but I don't have any cash? Is it lack of profits? You might be selling more and more, but you're still not making much money, and you don't understand why. And it's, what could that be? Does your business sometimes seem completely out of control? Small business owners suffer from these and many other worries that keep them awake at night. So how can you escape this? How can you stop this sleeplessness, this never-ending treadmill? So let me explain again why this is important. Firstly, business owners have to make a lot of decisions. In fact, running a business seems to be a never-ending stream of decision-making. For instance, how much do we charge? That's your pricing. Should we recruit another member of staff? Should we buy a new van or several new vans? Shall we move to new offices? These are all decisions that are made often on a daily basis. The second point is that to make good decisions, you need the right information, the right knowledge, and the right skills. And without the right information, knowledge, and skills, decisions can only be made from guesswork and often, a bit of a hunch or an emotional reaction to the situation, because you don't have, the cognitive information to be able to make the right decision. So every decision on a business will have an effect on the short, the medium, and the long-term numbers of the business. So you have to make lots of decisions, and these decisions will have an effect on the numbers, whether it's on the cash position of the business, whether it's on the profit of the business, or whether it's the business's value. So the value being how much you could sell it for, in effect, not necessarily that you are going to sell it, but how much it's worth. So making decisions without knowing the numbers and how they work in your business is a bit like getting in your car and you don't know how to drive, you don't know what the road signs means, you don't know what the various dials and indicators are. Eventually you're going to get lost or you're going to run out of fuel, essentially. So cash in particular is like the fuel in your business. So here are the top 6 practical reasons why you need to understand the numbers. Firstly, to tell you the story of your business. So that means you can look back and understand what's been happening. What has been the results of your business decisions and activity over the years or months or whatever that you're looking at in your reports. So it tells a story. Then it helps you identify not just the symptoms, but also the root causes of the problems. So for instance, if your gross profit is falling, that's a symptom. But there could be many different root causes, such as the wrong pricing of your business, or your items that you're selling, whether it's services or goods, you're pricing them wrong. That could have an effect on your gross profit. Often it's costs increasing without you putting your prices up, and that will affect your gross profit. I'll explain a bit more about gross profit in a minute. Poor purchasing, as I said, and wastage. In other words, throwing things away or things becoming unusable. So there's lots of things that you could do in your reports. Your numbers help you identify that there is a problem. Then you have to go and have a look and see what's causing it. Knowing your numbers actually helps you spot early warnings of something potential happening. For instance, first of all, you could say that if you look how long customers are taking to pay you on average, and this is something else we'll look at in a little bit, if that's going up, and as in the average number of days it takes to get paid, if you identify that early, then you can do something about it. If you only find out when your annual accounts are done, perhaps 6 months after your annual accounts, it's a bit late. Other things are areas of strengths and weaknesses can be highlighted. For example, your balance sheet indicates whether your business value is going up or down. There's a bit more to it than that, in the sense that not everything in your balance sheet is revalued every year, but it will give you an indication of whether the business value is going up or down. And also, talking about decision making, you've got to understand the numbers in order to make decent decisions, and how what the effect of your decisions has been on the numbers by getting reports. And finally, the one that everybody says, knowledge is power. The more you know about your business, the better your business is going to be. So these are the 3 key reports. Now, there are other reports that businesses often produce, but these I thought today I'd focus on the 3 main ones. And even said that the trading account can often be seen as part of the profit and loss account, and I'll explain that in a minute. And what we'll look at is, and look at each of these to help you understand why they're important, what you can learn from them. We'll work through an example to show the key things that you can learn from it and things to look out for in your reports. And we'll use the same fictitious company, we'll call them Foods Co, for the examples. Right, first one, the trading account. Now, you might not hear that expression very often. The reason that I've split it off from the profit and loss account is because it's so important, and I'll come back to that in a minute. But what I want to talk about, the trading account is, you can think of it as the top half of your profit and loss account. So if anybody's brought their accounts along to the webinar thinking, well, maybe I'll understand what they mean, then if you look at the profit and loss, especially at the back of the accounts, which are often called the trading and profit and loss account, the top half, the top bit, is the trading account. And what that shows you is, first of all, it's really just 3 lines. It can sometimes be 4. Is sales. That's a top line, often known as the top line. It's also known as your turnover. As I say, we're going to have a look at this in a minute, so don't worry too much about following this in detail. It shows under your sales, it shows your variable costs. Now, these are costs that vary, surprisingly enough, such as stock, materials, subcontractors, delivery costs. These are all the costs which vary pretty much directly with the amount of sales you're making. And then you have your gross profit. Now, your gross profit is basically your sales less your variable costs. So if you're really good at subtraction, you can work out what your gross profit is by taking your variable costs from your sales. It's that simple, really. So you can use the trading account to calculate the return you're achieving on your sales directly before deducting your overhead costs. And your overhead costs are things like expenses that don't vary much with sales. They're often fixed, like rents, utilities, salaries. I say it'll become clearer when we look at the example. Your gross profit percentage is the percentage of your sales that are left after deducting your direct variable costs. So again, remember there's three numbers. There's your sales, which most people understand. There's your direct costs, which it might just be what you buy. You know, it could, if you're just buying and selling, it's just stock purchases. And then you've got one from the other. You've got your gross profit. So for instance, if you sell £1,000 worth of stuff and your direct costs are £500, then your gross profit is £500. And that means that for every pound you sell, you get 50 pence to hold on to. And the gross profit can then be used to see whether your margins are improving or deteriorating. This is a really important measure, and somebody asked me, you know, what the most important number was in any set of accounts, and almost without exception, I would say the gross profit percentage. It's so important. It's very tempting, and I've seen it with a lot of businesses, to focus on the sales number. Yeah, we're a £2 million company. We're a £4 million company, you know, whatever. It's not really not that as important as the gross profit, because, for instance, a company selling £1 million of stuff a year with a gross profit percentage of 50% is less profitable than an £800,000 turnover company with a 70% gross profit rate. That's 500,000 gross profit against 560,000. So it's a gross profit that is really important, and that's when we're working with clients, that's a number that we monitor really carefully, because a small change in that can have a fantastic effect if it's an upwards change, and a horrendous effect if it's a downwards change on the actual bottom line. So, as it says there, if your business has different divisions or locations or whatever, you can actually do this, track it in the individual, trading accounts to see which one's performing best. That might not apply to an awful lot of our clients. And as I've said already, small adjustments to the items in your trading account have a huge impact on your overall results. So now I'm going to move on to an example, which hopefully will make it a bit clearer if you're a bit confused by all that. So here we have Foods Co. I mentioned, and this is their trading account. What we have is sales, as you can see, of just over £1 million. In this example, cost of sales and other direct costs are split, but sometimes they're all lumped together. But in this example, as I say, materials or stock purchases would be 318,000, given a gross surplus. In other words, one take away the other, of £700, £700,000. They've got direct costs, and these are things like packing materials and delivery costs, etc. And there's another 450,000, so their gross profit or the gross surplus is £248,749, or 24% of their turnover. So the gross profit percentage is their gross surplus, or gross profit as we often call it, divided by your sales to give you 24%. So you get to keep 24 pence of every pound you sell. Okay, so that's hopefully that's fairly clear. Now, the company's thinking, you might be thinking that's a good gross surplus, but what we need is to know what the overheads are to decide whether that is a good enough gross surplus, and we'll come on to that when we look at the profit and loss account. But at the moment, what we'll look at is how can they improve that? I mean, a rule of thumb, which, hold it lightly, is that a gross profit of below 30% is possibly not high enough for most businesses. So if you say we want a minimum of 30%, then that gives us an idea of what we need to change. So let's say that this company, for example, does some coaching with their accountant, and then they'd identify what things could be implemented to change or increase the customer retention rate So it results in a 10% increase in sales. Okay. They also work with their accountant to look at their stock processes. Now, what that could be is it could be making having better contracts with suppliers, less wastage, all sorts of things that could influence the cost of stock. So let's say we've got a 5% saving, not a huge amount. They then negotiate with their delivery provider, resulting in a 5% saving in their direct costs. They are there. And as a result of these small changes, so that's a 10% increase in sales, a 5% fall in the cost of sales, and a 5% fall in their direct costs, we end up with a gross surplus of 389,000, which is an increase of £140,000 just by these small changes. Now, we'll see the full effect on the bottom line in a little while, but what you'll see is the gross profit percentage is now 35%, which is an awful lot better than 24%. Okay. So understanding this, how this works, and what you can do, as I say, if you understand how the numbers work, and then understand how you can change or improve the numbers, then you can go ahead and improve the numbers. So understanding this in detail allows you to identify the areas where little improvements can have a really big impact on the profitability of your business. And for businesses who do have costs of sales and direct costs, this is probably the most important part of the business to look at. So what I'm going to move on to next, and we'll come back to Foods Co. Once we've just had a small introduction to the profit and loss account and just see what happens there. So it shows all your income and expenses over the year and tracks the overall performance of your business in terms of the profit or loss made. So you match your income with your expenses for the period. Now, the profit and loss, where this is different from cash, is done on what's called an accruals basis. Now, that's another bit of jargon. What it really means is we include items. The main things that are included in that are items that have been invoiced but maybe haven't been paid yet. So, for instance, if you do all your biggest and most work in the last month of your financial year and you invoice at the end of the month, so you've got a big invoice at the end of your financial year, that income won't actually have been received yet. It won't have been paid, but it is included in your profit and loss statement because it's been earned. So hope that's clear. So you can think, as I say, you think of the profit and loss statement as starting with your gross profit that we just looked at in the example, and then taking off all your overheads such as rent, admin salaries, IT support, utilities, etc. And these are things that don't really vary very much depending on the level of sales. As I say, in time, they may vary, but if the business is growing, like you might need more office or a bigger office or whatever, or staff. As I said already, it's really important to remember that profit is not the same as cash, because the profit in your profit and loss statement includes non-cash expenses such as depreciation. So you've got to be sure that you have sufficient profit to cover cash costs, such as loan repayments, asset purchases and drawings. And again, we'll look at that in a bit more detail further on. Your profit and loss statement provides a framework to benchmark your results by using percentages. So basically, you basically look at the percentage of your turnover that is used, that goes on various things, and then you can see trends building up. You know, why is our marketing costs getting a bigger percentage of our turnover each year? And that should be the other way around, surely. You know, there's all sorts of things like that you can look at. The other thing is, as it says there, a fundamental driver of business value. What that means is businesses are often valued as a multiplier of their earnings. So the better your profit and loss looks, the more your business is going to be worth at the end of if you were to sell it. The higher your earnings, the higher your value. Okay, let's actually look at some numbers then. Right. Okay, this is the rest, if you like, of the profit and loss statement. We've looked at the trading account, and the trading account produced, this is before we made the changes, produced a gross surplus of 249,000, almost 248,749. So that's the starting point for the rest of the profit and loss statement. You can see all these things here, all various bank interest, bank charges, rates, rents, all these sort of things that are fairly sort of standard. So what we can see is the company at the start of all this was making a loss, a net loss, and that's after all costs before tax, of £113,858. Not a particularly good situation to be in. It can't be sustained for very long. So let's say the company takes a review of all these expenses with their accountant and identifies some potential savings to be made, such as insurance and rent. Now, just 5% savings there. What you'll see is that they'll save £595 in insurance. Okay, it's not going to have a huge effect, but it's something. Seems a bit more on the rent. That's often possible, particularly at this time when there's lots of offices sitting empty. It might be possible to negotiate a rent reduction, rather than just moving out. Anyway, look at that. You might have noticed, if you're paying attention, that the accountancy fees have gone up by £5,500. If you have, remember the previous example, the company had engaged their accountant for coaching and other services. So there's been some increase and some decrease, but overall their expenses have gone up by a couple of £1,000s. But despite the increase in accounting fees, the overall net surplus has increased by £138,000 to £24,000 due to the savings made. Now, obviously, the savings, as I said earlier, the big savings were made here, up at the gross surplus, when they made the changes to the gross profit percentage. Now, some of you might see that this enables you to work out your break-even point. And we've talked about break-even in other webinars. Why is break-even, why is it important? Because this is when the gross profit in your trading account equals your overheads. In other words, you're earning enough to cover your costs. So in this case, at the beginning, we can work out what the gross profit needed, which was 113,000 plus the actual gross profit, which turns out to be 362,000 gross profit, and then we can gross that up. And this is where you need to be a mathematician, because you have to start doing dividing and multiplying as opposed to adding and subtracting. You can work out if your gross profit is 35% and your gross profit needed is 362, then your sales needed to be 1.5 million. So for a new business in particular, it's a vital number to know. So once you know what your sales need to be, as long as you're monitoring and tracking and affecting your gross profit percentage, you know that if you hit that sales figure, you will make the gross profit you need to cover your costs. And obviously beyond that, you know the gross profit, you know how much profit you're going to make if you exceed that gross profit figure. So all that makes a bit of sense. So you can see how just making some small changes can make some big differences to your bottom line. Right, let's move on to the balance sheet. This is the one that I find a lot of clients just don't understand. They don't understand what it's about. They understand profit and loss, they understand money coming in, money going out. Profit and loss is over a period. It's always over a week or a month or a quarter or a year. It's a record of what's happened over a period of time. The balance sheet's quite different. The balance sheet is like a snapshot of the financial position at a specific point in time. Usually done at least once a year in your financial reports that your accountant will be putting together. But you can produce a balance sheet anytime. So a really fastidious way of doing things would be to produce a balance sheet every month, because then you can see what's happening to the value of your business. as I say, it's one measure of the net worth of your business, your assets, less your liabilities. So that's essentially what your balance sheet is. It's all the assets of the business, like buildings, equipment, money in the bank, money owed to the business, stock, work in progress. All these things are all assets. They're all worth something. And the liabilities are typically taxes, whether it's VAT, corporation tax, pay as you earn, loans that be made to the business, whether it's bank or direct loans. These are liabilities of the business, and also supplier balances. So if you bought some stock, say, and you haven't paid the invoice yet, that's a liability. So in simple terms, as long as your assets are more than your liabilities, the business is solvent. In other words, you've got more assets than liabilities. If it's the other way around, then you've got a bit of a problem and you might need to do something because you're technically insolvent. So if you have more liabilities than assets, technically insolvent, you usually need to do something fairly quickly to fix it. One thing with the balance sheet is it's essentially a record of what's happened to your assets and liabilities between the last balance sheet date. So you start with a balance sheet at day one, you have your profit and loss account and all the things that you do, paying people, cash flows in and out all over the place, and then you take a photo again a year later, say, which shows what's happened as a result of your activities over the last 12 months, what's happened, what effect has it had to your assets, what effect has it had to your liability. So by looking if your balance sheet is getting better, it shows that you've got what we call a stronger balance sheet. It's easier to survive a downturn like what's happened over the last 6 months or so. So if you came into that with loads more assets and liabilities, you're much more likely to survive than you were the other way around. It also provides, the balance sheet also provides a way to measure key ratios, and we'll come on to that in a minute. These ratios are things that tell you how the business is performing and how you can improve them. So one might be what's called debtor days. Now, debtor days, it sounds a bit strange, but a debtor day, essentially, it tells the business how much money how much sales they've generated that haven't been paid for yet. So if you do a bit of work, invoice £1,000 to a client, and he hasn't paid it, then that £1,000 is a debtor. Now, to get your head around the idea of debtor days, which isn't that easy to grasp, but essentially, if you imagine that you operate for 365 days a year, and you turn over, your sales are 365,000. So on average, it's £1,000 a day for each of the 365 days. So you generate sales of £1,000 a day. Now, if your balance sheet shows that you have £10,000 owed to you, you know that that is 10 days worth of work. So that your debtor days are 10. It's exactly the same with stock. You can look at your stock and say, how much stock do I use over a year? So divide it by 365 and say, that's for each day I use roughly this amount of stock. How much stock have I got on hand? Divide that by the amount you use each day, and you can find out how many days stock you have on hand. So we're going to look at those in a second because these are ways of improving your cash position. Right, let's look at the balance sheet of Foods Co. Now, we said, remember, they were making a loss of 113,000 when they came along to see us. So looking at the balance sheet, now there's different layouts you can have for balance sheets, but they're essentially the same. It's basically company's assets less its liabilities. And what we can see here, that the assets are smaller than the liabilities by £305,000. Now that's a bit of a problem. In other words, if they paid all their liabilities, well, they couldn't because they're £300,000 short. Where are they going to get the money to pay that? We'll come back to that. The other thing I want to look at is a thing called working capital. Now, you might have heard the term working capital, and essentially it is the money that is circulating within the business to generate the profit in the business. An easy way to calculate it is to work out how your total current assets how your current assets compare to your current liabilities. Now, I'll explain that in a minute. In this example, we can see that the current assets are 138,000, their current liabilities are 162,000. Why is that important? It's important because current assets, as opposed to fixed assets, are those assets which can usually be turned into cash fairly quickly. So like actual cash, stock, other receivables, which is, well, trade and other receivables there, 72,000. That is what I was mentioning, they're debtors. That's another word for the same thing. Trade receivables are trade debtors. It's money that you've invoiced you haven't been paid for yet. So these things can be converted reasonably quickly into cash. Your current liabilities are, as you can see here, supplier invoices that you haven't paid yet, things where are going to use up cash really quickly, taxes payable, overdrafts. Now you might, if you're operating on an overdraft almost permanently, you might think that's a long-term liability, but in reality, the bank can ask for it back at any time. So it is a current liability. You have to be able to pay it back if they ask for it. So all these current liabilities. So up here, if they sold everything and got paid, they could generate that much cash, but that wouldn't be enough to pay all their current liabilities. So really, that would be a bit of a problem. So they need to do something pretty urgent. Now, if they can generate more business and get paid for it without incurring too many more liabilities, that would be a great way to do something about it, because of generating profit. By generating profit, you can increase the value of the business, because as long as you don't take it out as dividends. So this company needs about £24,000 to solve its short-term issues and negative working capital. In other words, it needs £24,000 to have enough current assets to cover the current liabilities. But that's not going to solve the bigger problem, is the 305,000 overall net assets that they're negative balance for. Now, how could they do that? Now, they want to explain why this is really important. If you have your own company and you're a director of the company, and people often, when they start a new company, they come to me and they say, is there any downsides to being a director? You know, and this might be because you're making a spouse or a partner a director for tax reasons, or it could be lots of different reasons for that. And generally, there's not much. They have responsibility to run the company, but it's their company. If they're the shareholders, at the end of the day, if they make a mess of it, it doesn't really matter. Except if the company is insolvent, the directors have a responsibility to make sure that it's not going to run out of cash. And if it is, stop trading. That's a difficult decision when you think the business can continue. So if they don't stop trading, then if they go bankrupt, essentially, go into liquidation, owing money to anybody, from any debt that they've incurred from the date when they should have stopped trading can be transferred to the directors personally. So that's one sort of, well, it is one situation where limited liability will not protect directors from personal liability. So that's really important. And that's the sort of thing where if you get to that stage, you really need to speak to, well, first speak to your accountant, but then also speak to an insolvency practitioner who will tell you what your responsibilities are in a bit more detail. So how else could they solve that problem? Well, probably there's only really two ways it could actually solve their working capital problem, and that is to either issue shares, because shares will means money comes into the issue. If they've got £306,000 worth of share capital issued, the bank, they would receive that in the bank. That's great, but it wouldn't be a liability. It would actually be an asset of the business. So it wouldn't. It would basically mean that their balance sheet was broke even, if you like. It would be a zero balance sheet. If they got a long-term loan, then only part of the loan would be in the current liabilities. The rest would be long-term, so their working capital, short-term working capital, could be improved. And that's probably what most businesses do. They've got a short-term working capital, i.e. current assets less current liabilities. They get a long-term loan, and that fixes it, because they don't have to pay the loan back for a long time. So what else could they do? If they don't want to issue share capital and they haven't got a loan, I mean, who's going to lend money to that company? There are things they can do, but they're kind of long-term things, and they won't really solve the immediate insolvency issue. They'll probably more affect the cash position. So let's have a little look at some things you could do. So debtor days, remember I explained debtor days a minute or two ago. At the moment, they've got £72,000 worth of stock, debtors, and that, how you work it out is basically the 72 over the sales figure times 365, and that gives you 26. Well, it's that over that times 365 is 26 days. So effectively, people are taking on average 26 days to pay. Now, if you implement some strategies to reduce the debtor days, say by 5 days, that gets you, in this particular case, gets me almost £14,000 of cash. Now, without getting too technical, all they've done is shift debtors into cash. So they haven't really affected the assets in total, but you can't pay suppliers with debtors or stock. You can only pay them with cash, really. So by converting other current assets into cash, you're able to pay your supplier better. Hope that makes sense. So similarly with stock or inventory. They've got almost £65,000 worth of stock. Similar calculation shows that they've got stock for 74 days. Now, if they could reduce that by 9 days by maybe buying less frequently or buying less each time, whatever, they could actually have almost £8,000 more cash in the bank. So again, that's not going to affect, it's not going to help their net assets, but it will mean they've got more liquidity, they've got more cash that they can use to pay and keep people away from chasing them. Okay. So, very important, the difference between profit and cash. There's a saying that turnover is vanity, and that probably ties in a little bit what I was saying at the beginning, where gross profit is the least is sanity. But net profit is sanity too, because if your gross profit only just covers your overheads, you're not making any real profit, as we saw. Cash flow is reality. Cash is like, if you think of again, I'll go back to the car metaphor. Cash is like your fuel, and your cash flow planning is like your fuel gauge. If you've got petrol or diesel, whatever, you know you can keep going. If you run out, that's it, you're over. Profit. Profit, as it says, is sanity. Profit really is the extra. It's the whole thing about business. It's the bit that it's why you're doing it at the end of the day. So what I find is a lot of business owners get frustrated when they look at their bank account, because it certainly doesn't usually reflect their profits. And it's really important you understand the difference. Profitable business can go out of business because it's starved of cash. As I was saying, it's a bit like, if you run out of petrol, it doesn't matter. If you've got a van loaded with a big delivery and you're going to get loads of money out of it, but if the van runs out of petrol, then it doesn't matter how big your sales, your order book is. If you can't deliver because you haven't got any cash to buy stock or whatever, then you can just go bust. Okay. Now, what I want to do here is go through a few items which sometimes confuse people in terms of whether it affects the profit and the cash. Now, as I've said already, you have to make enough profit, not just to break even or cover your drawings, say, as dividends, pay your taxes. You also need to make enough profit to cover the cash that goes out that isn't in your profit and loss account. So be honest with yourselves and probably write down as we go where you think each item goes. Does it affect your cash, or does it affect your profit, or does it affect both? Or possibly neither, but that would be a bit odd. Okay, what about VAT? Your VAT bill, does that affect your cash or your profit or both? Write it down and see if you're right. Affects your cash, it doesn't affect your profit because your profit ignores VAT. Your sales ignore VAT, your expenses ignore VAT. This is assuming you obviously have VAT registered. It doesn't affect your profit at all. Loan repayments, and what I mean here is the capital element, i.e. the repayment of the loan as opposed to the interest. What does that affect? Does it affect your profit? Now, some people think it does, and this is where bookkeeping often goes a little bit awry. If you're paying £500 on your loan every month and that's posted as interest, or the other way around, it's posted as loan repayments, but the interest part is included in it as well. So yeah, this is just the bit, the repayment of the loan, the loan capital, if you like. It does affect your cash, and it doesn't affect your profit. So you need to generate enough profit to pay your loan repayments. But interest on loans, where do they go? Obviously, it's cash and profits, because the interest is a deduction, it's an overhead cost in your profit and loss account. But you obviously have to use cash to pay it. What about asset purchases? Right, you go along, you're going to buy a new van, and you're lucky you've got enough cash. And so you go along, you take 20 grand or whatever it is, and you pay for a new van in cash. Does it affect your cash? Well, obviously it does. Does it affect your profit? No, it doesn't. So if you're going to go and buy a van with cash, you're going to have to generate enough profit to cover that. And not just profit, after tax profit, to cover the cost of the cash that's going out. Asset sales. So you've got an old van and you decide you're going to sell it. So you take it along and you get some cash for it. And as it happens, you get it the same amount as it's in the book value in your accounts. Does that affect your profit? No, it does affect your cash. Last one, depreciation. It's an expense in your account, so yes, it affects your profit. Does it affect your cash? No. The cash element of the depreciation is accounted for with the asset purchase or sale. So you can see that even if the business has made a really healthy profit, there may not be any cash left if you've spent it all over here. Okay. Right. The Business 101 cycle. This is a way to demonstrate the difference between profit and cash. Now, I'll be honest, some people find it more confusing. Other people find it, aha, I understand it now. So I'll just go through it fairly quickly. So first of all, you start a new business, the owners need to invest some money in the business. The business can't do anything if they haven't got any money at all. So even if it's just buying a laptop and some stationery, or but it might be a van or whatever. So the owners put money into the business, so the cash goes into the business. And that money can purchase the assets they need to run the business. Again, it could be a laptop, or it could be a van or something like that. Now the business might need extra cash because the owner might have only had £500 or something, but you're going to buy a van, it needs finance, so it could be hard purchase. We get a new van, for instance. Then these assets are used to generate a profit. So that profit is what that's all about. Now you can improve your profit by improving your margins or selling more. Drains on your profits are obviously things like expenses that are more than they should be. And if you get really out of hand, you can end in a loss. Assuming you've made a profit, that profit, you've earned the profit, you've sold whatever it is you do, whether it's goods or services, you've invoiced it, eventually it turns into cash. So hopefully, if you made a profit, there'll be more cash than went in at the beginning. So some drains on the cash are things like being slow to collect your debtors, holding loads of stock that you don't need, making loan repayments, making tax payments, payments to suppliers. These are all things that take cash out of the business. And you can actually achieve some gains by being quicker to collect your cash, getting your customers to pay you quicker, holding less stock, negotiating longer payment terms and better terms with your suppliers. And one of my favorites, reducing the tax that you pay. Because tax is really just another drain on the cash of the business, but it's just a really difficult one to quantify without some professional help. Then the owners, with this extra cash that's been generated because you made a profit and been paid, the owners can then take some cash out of the business as drawings or personal loan repayments. The money you pay at the beginning can be taken back again. Now, there's cash left over, which is always a good idea. It can be reinvested into the business to purchase more assets, and the whole thing goes round in circles. And the faster it goes round, basically, the more profit you make. And that's accelerate the spin cycle to increase the return on your investment, as it says there. Hopefully that, for some people, will help them understand a little bit how the cash cycle goes, how cash works in your business. So, looking at how the key drivers of business value, and what that really means is the things you should focus on to increase the value of your business. Now, part of knowing your numbers is understanding, measuring, as I say, the drivers of your business values, and they might be different things. There are usually some common ones, such as it could be monthly recurring revenue, it could be revenue growth, revenue per client, your actual sales figure, the gross profit percentage. And they'll be different, subtly different for different businesses. But what we often do with our clients is work with them to identify the drivers that actually help the business go and increase in value, because that's really what it's all about. Now, these are the things that you need to do, in my view, to enhance the value of your business. In other words, to improve your balance sheet. So the first thing is to get a really clear plan of what you want to achieve. And there's a whole host of processes and procedures that you can follow to get that plan. Have it really clear and specific in what you're trying to achieve. In other words, Stephen Covey says, begin with the end in mind, know what you're trying to do. Because if you don't know where you're trying to go, it doesn't matter where you go. Then the next thing probably to do, if your business is going to grow, is to document your organizational structure and all the roles within your business. We're currently redoing that with our business at the moment in order to make sure that we've got the right structure and responsibilities, etc., and roles, and to grow the business. We've worked with lots of different types of businesses doing this, and usually what they find is that it really does help them understand how the business structure works, and it also helps the people in the team, the people in the business, understand where they are in their business and how they fit in. The next thing would be to make sure you've got cloud-based real-time reporting on your numbers. That is really important. Now, I still occasionally see potential clients coming along who are using a sort of 19, well, maybe not 19, maybe that's not that long ago, maybe say 2006 version of Sage, and it's on their laptop, and it's not cloud-based, and it's only 2 people who know how to use it, and it's hard to get hold of it if the other person's got the laptop. If you use something like Xero or Free Agent, and there are others, what you can do is you can log in from wherever you are. Isn't that brilliant? You can log into your accounting system from anywhere in the world. So you're on holiday, you can think, oh, I wonder if they paid us, and log in and see what's going on, a bit like your bank. But the really important point is, if you do this, keep it up to date. It doesn't have to be hourly or daily like maybe I do. It certainly should be at least weekly. Keep it right up to date. You can then have meaningful reports from your accounting software. Again, it's got to be, the garbage in, garbage out rule applies. It's got to be right. But if assuming it's the bookkeeping done correctly, then you can see exactly where your business is. You can compare it with your plans and your projections and see how you're going. Next thing is to reduce reliance on owners. This is so important. Would you buy a business that needed the current owner, to work 12 hours a day to keep it going? Because if I was going to buy a business, I wouldn't want the owner to be there, at least not for very long after I bought it. So if they come out the system, out of the business, then what's the business worth? Not a lot. Whereas if the owner says, well, I just go in once a month and check the numbers and meet people and everything and see how they're getting on, that's worth a lot because it doesn't rely on the owner. So that's one thing. As I said, reviewing documents and systems and processes, you need to get these in place so that your business is worth something without you. And if anybody was at our business recovery planning webinar, we did it a couple of times last month, I think it was, managing risks, really important. And that can be big risks. I mean, if you were a video cassette producer, say in 2005, say, you might have thought things are changing. You need to look at long-term risk, short-term risks, and do something about them. So how does this all come together in, into one place, in practice? You've got, what you understand the numbers, how they work and what you can do about improving them. How do you bring it all together? Now, again, another webinar we did was called the 3 Essential Tools. So this is what we believe is the bare minimum you need to really get your business implementing all these ideas that we've been talking about. You need an annual business plan. That is, where will the business be in a year's time? So what will it have done? It will be the numbers, but there'll be other things there. It might be new markets. It could be anything. It could be completely changing what it does, lots of things. But you need to consider this once a year. And then you make a plan for that. Then you need to do a financial forecast based on those plans. And one of the things that does is kind of give a reality check to whether your plan's realistic, because once you've got in numbers, you can say, how on earth are we going to turn over 200,000 a month? Because that's what you said in the plan. So you might need to go back and rejig it a little bit once you look at the practicalities of the numbers. And then there's no point just doing that, having a plan, a forecast, sticking it in a drawer for 12 months and finding it again and going, oh, what have we done? Oh, we haven't really done anything like that. You need to have ongoing reporting. Now, minimum probably quarterly to see if each quarter you've achieved what you're planning. I prefer it to be monthly, because monthly, the more you do it, the more likely you're going to do the action points that come out of each plan. So, we've got to do this. How are we going to do it? Right, let's monitor it in a month. Let's look at the numbers. Did we do what we said we were going to do in terms of sales, turnover, whatever your important numbers are? Did we do it? And if not, what are we going to do about it? If you do that, the more frequently you do it, the more often you can make a difference. And the last thing there is accountability. Accountability means having someone who understands the numbers as well to hold you to account. Because we've all done it, we've made a plan and then we've forgotten about it, or we've been too busy. This is ironic because the point of the plan is to stop you being so busy, but one of the purposes of them. So you need someone to have a kind of accountability coach, someone who's going to hold you accountable. And as it says there, knowing the numbers is just the beginning. It's the beginning because it allows you to improve them, ultimately achieve the goals for your business. So, what are the next steps? Now that you know this, now that you're a part qualified accountant, I suppose, or qualified by experience, I think you should get started now. Hopefully you've got some paper and pen. Write down 3 actions, 3 things you're going to do that will add value to your business. And remember, adding value to your business in terms of the numbers is making your balance sheet stronger, having more assets, fewer liabilities. What 3 things could you do? And we saw some things already, improving sales margins, these sort of things. So a very positive approach here. Problems and opportunity to create a project. In other words, you understand how the numbers work, you look at the numbers, and you can now see where the issues are, especially if you look at trends. So then instead of going, oh my God, what am I going to do? You can actually say, well, I know what I can do. And you can start doing something about it. And as it says there, doing nothing should not be an option. Don't think I've seen many businesses where they wouldn't benefit from doing something differently. Maybe just a small thing, but it could have a big effect. So quickly, we're almost there now. How can we help? We have a few services that are relevant in terms of understanding the numbers and help to implement the plan that you're going to make. The first is business planning, which basically will produce a 1-page, although it's 2 sides of 1 page, business plan, which will look at all things such as ideal clients, what you're trying to achieve, look at the numbers, any action plans, and break it down into 90-day goals. We normally charge £1,500 plus VAT for that, but up till the end of December, we're offering it £995 plus VAT, as we do understand that a lot of people are struggling cash-wise at the moment, and we can always look at payment terms if absolutely necessary. An annual financial forecast, exactly the same price and the same terms. So if you remember when we said the 3 things you need: to plan, forecast, and some form of accountability. Now we've got quarterly coaching at £500 plus VAT a quarter. So what we would do would meet quarterly, we'd look at the numbers, we'd look at your actions, usually for about a couple of hours, and just agree an action plan going forward and update any sort of forecasting that needs to be done. Monthly coaching, usually a bit shorter, maybe an hour and a bit or so. £300 plus VAT. That helps you stay on track more frequently. Now, a new thing we've got here is management reporting. That's free to existing clients using Xero. We'll be rolling that out over the next few months, and that will be an automated process. That's why we can do it for free. And finally, a complimentary meeting for clients and for people who aren't yet clients. It's an opportunity to meet for an hour. At the moment, obviously, it's on Zoom. Meet for an hour. We look at your business goals, your plans, what you're trying to achieve, and anything else that's on your mind about your business and your finances, and we see if there's any way we can help you. So that's how we can help. And you'd be glad to hear, about a minute over, we're at questions. So I'll now hand back to Ikra, and hopefully Ikra will see if there have been any questions.
Thanks, Ian. Yep, we do have some questions, which we'll quickly run through as we have hit 11 o'clock. So if anyone does need to leave, please do make sure that you fill out the questionnaire that will pop up when you do leave. And if you do have any questions, please put them in the Q&A box and we'll answer as many questions as we can. So we've got a question here, Ian. How often would you advise that I check my income, expenses and cash flow?
Right, a good question. I think it depends on several things. It depends on your business, how big your business is and how complicated it is. It depends on how your cash flow is. The better your cash flow, the less you need to check it. If you're a new business, I would say doing it at least once a week is a good idea, because then you learn to understand how your business is working, and you learn the bookkeeping. I always say, do the bookkeeping yourself to start off with, and if you don't know how to, we can teach you. But do it yourself, because then you have a much better in-depth idea of how your own business runs. Eventually you can delegate it, but I would say doing it weekly at the start. If things are difficult, then do it more frequently as frequently as you can be bothered. The other benefit of doing it more frequently is that it doesn't build into a big and insurmountable pile of stuff that needs to be done. You know, if you're using Xero, for instance, you don't want to be going and seeing there's 250,000 transactions to reconcile. You much rather go in and see there's 5 or 6. So, and you can just do that very quickly, and it means it's kept up to date. So it doesn't. I can't answer it specifically without knowing, you know, what the business is, etc. But that's the general principles I would apply.
Yeah.
Okay.
We've got another question here. I run a service business. How would you work out your gross profit if you don't sell any goods?
Good question. Yeah, I mean, I tried to keep it as simple as possible in the webinar, but if you're a service business and you don't sell stuff, then really what you're selling, although this isn't to do with pricing, but you're kind of selling your time, or the time of your employees. So really what you need to do is identify the employees that work directly in producing the service, not your admin staff or marketing or whatever, but your people who deliver the service. So for instance, in an accountancy firm, it would be your accountants, people who prepare accounts, do payroll, VAT returns, that sort of stuff. Take their salaries and treat their salaries as your cost of sales in that trading account. So for instance, if you might have a service business that's turning over £1 million, and you've identified the salaries that the amount that relates to the people who generate the income directly, stick them as your cost of sales. So you've got £1 million, and let's say it's £300,000 of salaries, so you've got £700,000 gross profit. That's the way I would do it. And obviously, if there's any other costs, I mean, if you were a beautician or something like that, you'd have those salaries, but you'd also have some bits and pieces, like, you know, sort of I don't know, eyelashes or whatever. I don't go to beauticians very often, but that sort of thing. You know, there might be some materials involved, but not significant compared to the salaries usually. Okay.
Yeah, and we've got another question here. What is the difference between annual accounts and management accounts?
Right. Annual accounts, as produced usually by an accountant, are produced according to accounting standards, and they're what we call financial accounts. And they would always include depreciation, tax, adjustments for timing differences, etc. And they are produced to fairly detailed rules. and they go to Companies House and say shareholders and possibly to the bank if you've got loans, etc. Management accounts are, in a sense, whatever you want them to be. Now, obviously not exactly whatever you want them to be, but you can sort your reports into whatever is meaningful for your business. So you might put certain expenses or costs in a different place than you would in your financial accounts. You might not bother with tax. You know what you need to make profit-wise. You don't need to think about tax. You know, in your management accounts potentially. You can group different things in different places to tell you the information that you need to manage. So that's the point, really. Management accounts produce the information you need to manage the business. Financial annual accounts report on what happened over the last year and using accounting standards, which isn't necessarily the same thing. So hope that makes sense.
Yeah, thanks, Ian. And someone did ask a question if is there an ability to watch this back at a later date, and they would quite like to rewatch it a few times. So yes, the webinar has been recorded and we will hopefully get it out to you all either today or early next week. So that's all the questions that we've had. Thank you everyone for attending the webinar, and please do fill out that questionnaire when the webinar finishes. Any last comment from you, Ian?
No, I just hope it's been useful. It really is the core of what we do, I suppose, at Rosen Associates. We don't just do the financial accounts, we actually want to help make businesses better, I think. And that, hopefully there's an insight into some of the things we can do there. And thank you for everybody for coming along, obviously.
Thanks, everyone.